time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
We got a question from a listener or a viewer. Said that Brenda was her name, that she's owned Mullen Group. She wanted to get our analysis of it. She's done well. And yes, I'm very aware of Mullen Group. And in fact, we are in the process right now of putting together our 2023 Canadian Dividend All-Star Report. This is where we look at every dividend stock in Canada, about 350 companies, and we do analysis on all of them to find the best stock. So Mullen's a company I've been following for a couple of years. It has very strong fundamentals. It's right at the top of our monitor list. Could even possibly be a recommendation. But let's just go through the company, and then we'll talk about the summary at the end. So Mullen Group trades under the symbol MTL on the TSX, just under $16 per share. It's a $1.4 billion market cap company, and it pays a nice yield right now of 4.7%. So it is a dividend payer. They are a Canadian-based trucking and logistics company. So they have four segments to the business. Less than truckload. That's the largest final mile network in Western Canada. So these are short range deliveries. That's a lot of like e-commerce stuff. Things are sent to the warehouse. You only have to deliver them a short distance within that different region. The other segments of the business are logistics and warehousing, specialized and industrial services, and U.S. and international logistics. It's really the less than truckload that the company has focused on growing substantially over the past year or two here. Taking a look at the 1-year chart, a pretty good performance just over the last 12 months. It's trading, as I said, right now at about $15.50. That's up from about $11.50 per share a year ago. But if we look at the 5-year performance, not really that great. I mean, it's kind of moved up and down, but more or less flat over the past 5 years. The company did recently put out their Q3 results, and they were positive, essentially right across the board, very positive. So in the third quarter, revenue was up 20%, adjusted operating income up 52%. They produced higher net profit margins, 14.8% compared to 13.1%, 168% growth in adjusted earnings per share, similar growth in cash flow per share. And in addition to being a dividend payer, they're a dividend grower. The dividend has been increased 50% over this time, so 18 cents per quarter right now compared to 12 cents in the previous year. So very strong financials in the quarter. And then also the year-to-date financials were very strong. The balance sheet as well looks fairly good, about $630 million in net debt, which equates to a net debt to cash flow ratio of about 2 times. So, fairly good leverage ratio there. But let's take a look at what's been happening with the company historically, because as I'd said, over 5 years, the stock price hasn't really gone anywhere. So if we look at the historical numbers, we see a really nice acceleration in growth in 2021 and then year to date in 2022. But up until this point, going from 2014, say, to 2020, not really a lot of growth in revenue. And in fact, it wasn't until 2021 that they achieved the revenue that they had in 2014. Free cash flow for the current year, they're looking at 110 in free cash flow is what they're targeting. So that's up from just under 100 million in free cash flow last year, but would still be flat compared to 2020 and below the peak free cash flow, which was in 2014. So really not a lot of growth in this company long-term, but very nice growth recently. So this is one of the things that I've been looking at about the company now. The recent performance, one of the things that has been driving it has been inflation. It's actually been a net positive for them just recently because they've been able to increase prices. They've also been doing acquisitions. But as we look forward on the company, it may not be a good idea to focus so much on what they were doing in the past because the business really has transformed quite a bit. They've shifted their focus since that period, 2014 and up to 2020. So if we look back to 2014, they were mostly an oil field services company, about 2/3 oil field services and about 1/3 trucking and logistics. Well, based on acquisitions that they've made, they've completely transformed that weighting. So now as I said, the biggest segment in the company is the less than truckload segment. That's almost half of the business right now. They have other areas as well. There's the U.S. international and international logistics. So that's just trucking in the U.S., where they basically act as like a brokerage service low capital expenditures, good margins there. And then there's their logistics and warehousing as well. So the specialized and industrial services, this would have been what they would have considered oil field services back in 2014. And over this period, it's gone from about 2/3 of revenue to, I would say, less than a quarter of revenue here. So there has been a lot of change in the company. This has been driven largely by acquisitions, almost 600 million in acquisitions completed between 2014 and 2021. They've continued to do some deals in 2022, having done an acquisition in the second quarter, and they're looking to do more. And as I said before, most of that has been in the e-commerce focused business, the last mile trucking business. Close to 350 million in acquisitions over this period of time. Company expects e-commerce to continue to be a strong growth driver. They've quoted data from Statistica that they're expecting continued growth in e-commerce sales going out to 2025. So this continues to be a segment of the economy that they want to focus on as for growth. Now, going through the company's commentary from the recent quarter, there's a few things that I'm highlighting here. One of the things that the CEO said is that this is currently the best operating environment that he's ever seen in his life, the best in the company's history. So that's great. Inflation is driving increased pricing. So I know from reading their conference calls, their margins were under pressure last year, but they knew that they were going to start pushing through some very significant price increases due to inflation. They've done that, and this has driven a lot of the growth, in addition to acquisitions. Now, they say that experts are predicting a moderation in future results because of central bankers increasing interest rates, the expectation that the economy is going to slow in order to tame inflationary pressures. I would agree with this. You can't look at that 168% earnings growth rate, or even really the 20% revenue growth rate and expect that you can extrapolate that going forward. That's unrealistic. So I would expect results to moderate going forward at some point, maybe not next quarter or the quarter after that, but at some point over the next year here. But that doesn't mean that results still aren't going to be strong, because you've seen in year to date and for the third quarter of 2022, those are exceptional results. So maybe they're not quite as exceptional in 2023, but it still does appear that they have some good growth drivers in place. And if inflation persists, that they will be able to pass those some price increases. But they say as consumers are still spending, there's still capital projects that are being pursued, and all of this requires freight, logistics, and warehousing services, which they provide. So they continue to be very optimistic in that respect. And then finally, just a talk about valuation. Trading at 11 times trailing adjusted free cash flow, about 13 times expected targeted free cash flow. So the valuation looks good. Ultimately, this is one of the companies at the top of the list for a Canadian Dividend All-Star report, one of about 10 that we don't currently have coverage on. So at some point in time, it could be a recommendation. We're just continuing to dive deep. But that report is going to be coming out around year end. So look out for that, as well as some other great ideas that we have in there as well.
Look out, that report might hit you in the face.
It might.
Oh, God.
Yeah, you should hope that it does, because you don't want to miss it, right? Well, you think like 350 dividend companies in Canada. We're looking at every single one. So I just walked through Mullen. That's one of the top 10 that we don't currently have research on. But there's others that are equally impressive. And, I expect a couple of those are going to get into our buy research coverage, if not in the next month, then over the next couple of months.
Yeah, I think Mullen's interesting. The growth, the tremendous growth in the last year. I guess that I'm looking at some estimates going forward, and they're anywhere from flat to down around 7% next year. Mm-hmm. Analysts can get stuff wrong all the time. That's the issue. That's why we have to look deeper into it than just looking at
especially
estimates.
When you're dealing with like what's a fairly unknown company. Like there probably aren't many analysts that cover it. But I can't really say at this point. I can't say. I would say, it wouldn't surprise me if numbers were flat in 2023, because you're coming off of such extraordinary results in 2022. You're not going to do that every year, but typically the analyst expectation isn't going to factor in acquisitions, and then if there are more price increases, then that would be beneficial, obviously.